fallout from the collapse of Silicon Valley Bank. Joining us now is Fundstrat's Tom Lee. Tom, the NASDAQ ended higher in all of this, as some believe the Fed is not going to raise in March. Crypto rallied. What does that tell you?
Well, the last couple of days have been really tough for the markets, but I think this credit shock that's reverberating from the Silicon Valley Bank failure is the first signs that the Fed's monetary policy is finally biting. And I think, one of the takeaways we have when we look at what Fed Fund futures have done, which is now priced in cuts by year end, and the drop in yields, is that there are some deflationary forces being unleashed because of both the shock to the startup community and the regional banks having some tightening of lending standards that's surely to follow. And I think it does mean disinflation maybe finally have happened. We may have sort of broken the back of inflation.
All right, we have some breaking news right now from the Fed. Steve Liesman has the details. Steve.
Thank you very much, Morgan. The Federal Reserve at this hour is announcing a review of Silicon Valley Bank and its supervision of Silicon Valley Bank in light of its failure. We have a quote here from, excuse me one second. We have a quote here from Michael Barr, the Vice Chair of Supervision, who will lead this. He says we need to have humility and conduct a careful, thorough review. Fed Chair Powell saying the events surrounding Silicon Valley Bank demand a thorough, transparent, and swift review by the Federal Reserve. They are promising to make that review public as of May 1st, so fairly quick timeline for the Federal Reserve. Morgan?
Steve Liesman, thank you. Tom, I want to get your reaction to that because you just mentioned the Fed Funds futures market and just the dramatic repricing we've seen there in the last couple of days. Scott, at the end of the 3 o'clock hour, noted that the 2-year Treasury note has slipped below 4%. We've seen the de-inversion pretty dramatically. It's still inverted, but not nearly as much of the 2 to 10-year spread as well. What is the bond market signaling here, and what does it tell us about the Fed next week and that weighing by Federal Reserve officials of inflation that's still high versus now the possibility of risk and something potentially being broken within the banking industry?
There's a couple of reasons that yield curve is de-inverting because, the curve that people are referring to is the 10-year versus the 2-year. It could be de-inverting because financial conditions in terms of Fed policy is starting to ease, and that's why the 2-year is dropping. The 10-year never really responded. It could also be de-inverting because you're breaking inflation. If inflation is no longer going to be running at 5% the next 2 years, and the 10-year was always forecasting roughly 2, you're going to de-invert as inflation's breaking. So I think it means something definitely broke. I don't know if it's the economy or if it's inflation.
Steve Liesman, I want to go back to you for a moment on that breaking news that you just brought us about the Fed conducting a review regarding Silicon Valley Bank. Now, I wonder if this is in part, Steve, a review of the Fed's own, action or lack thereof. One of the things that the Fed is supposed to do, right, is promote the safety and soundness of individual financial institutions, monitor their impact on the financial system as a whole. I guess ideally that happens before something like a Silicon Valley Bank collapse happens. So what are they perhaps investigating?
No, it is precisely a review of that. The release, John, says that they are reviewing a review of the supervision and regulation of the bank. That's what they're reviewing in light of its failure. And I think, John, you put your finger on what they're after. They're after, how did this thing fail? Why were there no red flags or apparent red flags raised ahead of time? It's even unclear, by the way, what the Fed knew and when it knew it. Some of the tale of the tape that I've heard is that it was really the rating agencies that flagged investors and others that there was a problem there, not the regulators. I don't know what happened behind the scenes, if the regulators were on Silicon Valley Bank, if somehow they missed something that was key in the books or whatever. But what underlies this, Jonathan, is that the safety and soundness of the financial system is entirely about confidence. And if there is no confidence that the regulators are not on the ball, then you have a big problem with confidence in the system itself. Because frankly, average depositors, even sophisticated depositors, do not have the tools or the ability to evaluate the safety and soundness of banks. So the Fed does need to do this, and in fact, it does need to move quickly because it's going to be a critical pillar of restoring confidence to the system.
Okay. Tom, you were bullish even before we saw all of this fallout, and let's be clear, 3 banks now failing in the past week. Why do you continue to be bullish here, especially if we are talking about confidence and that being something that is going to essentially decide or determine whether we see more potential, and hopefully we don't, but more potential runs on banks?
Well, in the near term, I don't think it's bullish. We notified our clients Friday and reiterated this morning that there is going to be sort of lingering and ping pong and second order effects. So I do think it's tough, and it's a tough time for investors to be adding risk here. But to me, the reasons I can still state constructive intermediate term is, number one, I think the biggest risk has been not only inflationary pressures, which look like they could be broken, but it's also that the Fed's policy was actually creating a lot of the strains in the banking system. I mean, as it's being pointed out, deposits were shrinking as excess savings is disappearing. And at the same time, the securities portfolios, which these banks hold, which is a function of prevailing rates, was taking losses because of higher rates. So as the Fed's pausing, that's helping to stabilize that situation. So I think a lot of this it's tough right now because the dust hasn't settled. But I think the key to watch now is the resilience. I think the market has shown pretty impressive resilience, and I think that's a good sign. But longer term, 10 years down, VIX is falling, and we're finally getting softening in the jobs market, but we're expecting to, and that should help break the back of inflation.
Steve Liesman, I want to ask you a question. I know you got something to add as well, but it occurred to me, I was wondering, why do people think that the Fed might not hike in March just because there's a bank that bought long-dated bonds, more than a year ago? But what you mentioned about what the Fed is looking into sort of shifts my thinking on that. If the Fed feels some culpability that it did these rapid, hikes, 75 basis points, and perhaps wasn't looking as closely at the impact as the Fed should have been, could that not be a rationale for the Fed to say, hey, look, maybe this is on us. We don't know. Let's pause for a moment while we take a look at what happened here.
Yeah, John, I'm not sure they're investigating this really interesting area that you just raised, which is the cross-section or the intersection, of monetary policy and supervision. Right now, this says supervision. Maybe the monetary policy aspect is part of it. But the reason why people think the Fed might stop here is a couple. First of all, they could stop as a matter of prudence, as a matter of giving the banking system a little bit of time to catch its breath. An example of that, John, you remember back the pension problem that they had over in England. Bank of England stopped for a month its quantitative tightening and then resumed it. Of course, that was a limited problem. This is a broader banking confidence issue. We have here another reason, John, for the Fed to stop, or the reasoning behind this, is that this event is a massive disinflationary event that has the effect of tightening lending policy, tightening monetary policy throughout the system. If indeed banks do pull back, have to pay more in interest, tighten their lending standards, then that is the same effect as the Fed tightening interest rates.
Yeah, goes back to the point I think you were just making as well, Tom Lee. Thank you both for kicking off the hour with us. Steve Liesman with breaking news and Tom Lee with market insight.